Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Once again, it is your tutor, Samuel Muchai, your Accounting Made Simple tutor. Today, once again, I want us to solve a question on incomplete records accounting. This is an area I'm dealing with because of the great demand that I've always gotten students asking, incomplete records accounting. And I like saying, this is actually one of the simplest topics where you can score 20 out of 20. If only you make up your mind that you're going to follow the double entry rules. You just follow the double entry rules, and a few of the traps, you learn about a few of the examiner's traps like we show in our classes. We don't just teach, we teach with clear objective of ensuring that every examinable trick is revealed to you. So today I want us to solve a question called CPA 1, Financial Accounting, November 2019, question 2. November 2019, question 2. Now, like I've always said, please like, share, subscribe, support us, and join our online classes. We are simply the best. We've done this for the last 16 years, and I can assure you that we are the best in what we do. So the question reads, Regina Rai is a businesswoman who does not prepare proper books of accounts. She makes a gross profit to cost of sales of 3 over 7 per annum. The following balances were extracted from her records as the 30th of September. Land and building, equipment, furniture fittings, motor vehicles, inventory, accounts receivable, prepaid rates, bank balance, 15% bank loan, accounts payable, accrued electricity. Additional information number 1. On 1st of April 2019, Regina prepaid part of the loan by check of selling 6 million. Number 2, Regina did not maintain records on cash withdrawn from the bank for personal use. The balancing figure in the bank account is to be treated as personal drawings. Number 3, total sales for the year ended 30 September 2019 amounted to 3.6 million, while purchases amounted to 253,200 for the same period. All purchases and sales were on credit. All purchases and sales were on credit. The discounts for the year ended 30 September 2019 were as follows. Bad debt written off during the year ended 30 September 2019 amounted to 240. On 1st of April 2019, Regina purchased some equipment for use in the business at a cost of 600,000. No depreciation is charged on the year of purchase. The following expenses were paid by check during the year. You are required to prepare the income statement and the balance sheet. Like I've said, you need to be very, very sensitive, and I like telling students, practice makes accountants. Practice makes accountants. Now, it is when you do so many questions that you discover the examiner's tricks. It is when you do so many questions that you discover the examiner's tricks. If you look at this question, if you look at the listing right from the beginning, you realize you have not been given capital anywhere. And many times when you find you've been given a listing of assets and liabilities from one year to the other year, one of the things you always quickly need to ask yourself is, have I been given the capital account? Have I been given the opening capital? So when you got down to preparing the balance sheet, you have to say capital, add profit, less drawings, where the closing capital. And in this question, you can see you have not been given. This is a straightforward question. There are questions that you find you have been given the listing of assets and liabilities, and also the bank account. When computing opening capital, many students just go straight the assets and liabilities, they forget that the bank account is part of the assets. The balance brought down, the opening balance of the bank account is part of the assets we had at the beginning of the year, and the balance carried down is part of the assets at the end of the year. So one of the most important things is to compute the capital that way. But as you do that, reconstruct the accounts. I encourage students, reconstruct the accounts, even the accounts you're not making changes, so that you will extract everything from your working papers. You will not be going back to the question to get some information. So in this particular question, quickly, I just start do my workings, and I will start with computation of opening capital. Computation of opening capital. Computation of opening what? Capital. Computation of opening capital, and we say clearly, land and building is 18,000. Land and building, you don't even have to write in full, 18,000. Equipment, 4,800. Furniture and fittings, 2,400. Motor vehicles, 6,000. By the way, you could actually be given these assets at cost, and then you're being given the depreciation. You must know that an asset is the net position. So you get the original purchase cost minus the depreciation, you get the net position. That is what you consider to be the value of the assets. Motor vehicle, inventory is 3,600. Inventory, 3,600. Accounts receivable, 5,400. Accounts receivable, 5,400. Prepaid rates, 180. Prepaid rates, 180. Bank, 1620. 1620. So you get the total assets. We know how to get capital. We know how to get capital. We say assets is equal to capital plus minus what? Capital plus liabilities. Asset is equal to capital plus liabilities, which implies that capital is equal to assets minus liabilities. Capital is equal to assets minus liabilities. So we get the total assets minus total liabilities to ensure that we get capital. So we add them up, and we get, we add them up, 18,000 plus 4,800, 18,123 plus 4,800, we get a figure of 22,800 plus 2,400 plus 6,000, 9,600, 6 plus 3, 9, 3, 6, 9, 6, 9,600 plus 5,400 plus 180, 5,400 plus 180 plus 1620, we get a figure of 42,000. That becomes 42,000 less liabilities. Now, you must be very careful to ensure that all the opening assets are captured and all the opening liabilities are captured. I want to repeat, at times the bank balance is hidden in the bank statement. So less liabilities, our accounts payable is 2,700. Accounts payable is 2,700, and our accrued electricity or electricity payable is 300. Is 300, meaning 3,000. So our total liabilities is 3,000, giving us a capital of by the way, we have a 15% bank loan, 15% bank loan, 15% bank loan, 15% bank loan, bank loan, amounting to 12,000. We add the 3. We add the 2,700, 3,000, it becomes 15,000. This becomes 15,000. 15,000 minus 42. 42 minus 15, we get a figure of 27,000. That becomes our opening capital. That becomes our opening capital. This is opening capital. So in our balance sheet, we will say capital 27,000, add the profit for the year, less closing, less drawings. So that's the way to get capital. That's the way to get capital. That's the way to get capital. You know, anytime you get this kind of a question, you must ask yourself, what is it that I've not been given, and what is it I'm supposed to compute? And that's why I like saying, read through the question. Don't be in a hurry to start solving the question. First of all, read through the question, because you're able to even tie some information. You're able to tie what you're being given in the trial balance and the additional information, so that you have a clue of what you're supposed to do. So this is how to get your capital account. This is how to get your capital account. And because of space, I will delete all this and I will retain my capital account at 27,000 here, so that I can have the workings to reconstruct all the accounts we have there. We can have the workings on, we can be able to reconstruct everything that we have there. So from there, we actually, all we do is we reconstruct all the accounts, so that when it comes to preparing the income statement and balance sheet, we will extract the information from that there will be nothing to miss. There will be nothing to miss. You will not be looking at the question to scout for answers. There will be nothing to miss. There will be nothing to miss. So quickly, whatever given, I do it. Some students will just go to the additional information without reconstructing, getting the opening and closing balances. You just get the additional information, you do the calculations without getting the opening and closing balances. For instance, you have told something about debtors, but you're not getting the opening debtors and the closing debtors. You do something about accounts payables, you're not getting something about the opening and closing accounts payables. So we come to land and building, and we say balance brought down and balance carried down. Balance brought down and balance carried down. It is 18 and 18. 18,000. Nothing much changing. Then land equipment, our equipment are moving. Our equipment account is moving. Balance brought down of equipment is, again, look at the years. Be careful with the years. Where is 2018 and where is 2019? Where is 4,800, balance carried down. 3840. Our equipment is going down. Furniture and fittings account, balance brought down is 24,1920. 1920. Balance carried down is 1920. Motor vehicles 645. Motor vehicles. Do it quickly. Account 6,000 and balance carried down 4,500. 4,500. Then we have inventory. That one, we can leave it that way, but you can still say in inventory. And we have opening and closing. Our inventory, that is 600, and you can see we have not been given the closing. We're supposed to calculate. Accounts receivable 5472. Accounts receivable, account 5472. We have rates. Prepaid rates. Balance brought down. Prepaid rates. It's an asset. It is an asset. 180 to 40. 180. Balance carried down is 240. Balance carried down is 240. And then we have bank, and we need to maintain this one. We need to give it enough space. Balance brought down is 1620. Balance brought down is 1620, and balance carried down is 15630. 15630. Loan, 15% loan. 15% loan account. Balance brought down, and balance what? Carried down. 12,600. 12,000s, 6,000s. 12,000s, 12,000s. We have accounts payable. You have accounts payable. Balance brought down, and balance what? Carried down. 3,000s. 2,700, 3,000s. Are we together? Accrued electricity. You must know what we mean by accrued. Anytime you are told something is accrued, you are told it's a liability. You're told it's a what? It's a liability. So when you bring it down, when it's electricity, accrued, you bring it to the credit side. You bring it, balance brought down. Accrued liability 300. 300. It means we have not paid. It's a liability. It's not an expense. It's a liability. It was an expense last year, but it was not paid last year. So you bring it down on the credit side. And then balance carried down. We are told it is still accrued. At the end of the year, we have 480. We have not paid 480, so that it becomes a liability open the following year. It becomes a liability the following what?
Yeah.
The following year. Now we are reconstructing the accounts as given. Reconstructing the accounts as given. Then you are told on 1st of April 2019. Dates are very, very important in accounting. Dates are very important in accounting. We are told on 1st of April 2019. Our year ends that year of September. 2019, and therefore the year begins this September, the year begins the following day, 1st of October. 1st of October, but the previous calendar year, 2018. Our year begins 1st of October 2018, and it ends on that year of September 2019. Now we are told in the question of additional information number 1, on 1st of April 2019, 1st of April 2019, 1st of April 2019, 1st of April 2019, how many months to the end of the year? April, May, June, July, August, September. 6 months. These are 6 months. These are what? 6 months. These are 6 months. These are 6 months. And therefore we are told, along that time, Regina repaid. So we are being told between this, in these 6 months, Regina, the loan was 12,000. The loan was 12,000. The loan was what? 12,000. But here they paid 6,000. Here they paid 6,000. On 1st of April they paid 6,000. And therefore from here to here, the loan that is earning interest, it is 6,000. It is 6,000. So the interest, the loan interest, the loan what?
Interest.
The loan interest is, the interest rate is 15%. 15% times 12,000 for the first 6 months times half of the year. Times half of the year plus, yes, this is loan interest expense, plus 15% of this time, this other section, we are only having the loan for 6 months. But we only have 6,000 loan. Here we paid the first 6,000, so we are left with the 6,000. So the loan for the last half of the year is 6,000. Of 6,000, but not through the year, half the year. Half the year. Half the year. Giving us loan interest amounting to 15% of 12,000, 0.15 of 12, 1, 2, 3, times 0.5. You get a figure of 900 plus definitely 450, because this is half of it. So total loan interest plus 450, we get the interest expense amounting to 1350. We get the interest expense amounting to 1350. The total interest expense amount to 1350. Now, we will check whether we have been told whether we paid the interest expense. So, but we are told on 1st of April 2019, Regina paid part of the loan by check of 6,000. So we know our loan interest is 1350. Our loan interest is what?
1350.
1350. Our loan interest expense is 1350. Number two, Regina did not maintain records of cash withdrawals from the bank for personal use. The balancing figure in the bank account is to be treated as drawings. The balancing figure here. Number three, total sales for the year ended, that is September 2019, amounted to 360 million, while purchases amounted to 200,000 for the same period. All purchases and sales were on credit. All purchases and sales were on what? Credit. So if we were to say accounts payable, our accounts payable is here, by the way, and I don't know whether we have, yes, accounts receivable is also here. So our total sales for the year is 360. So we are debiting accounts receivable with 360 as we credit sales. As we credit what? As we credit sales. When we buy on credit, we debit accounts receivable and we credit sales. And we credit what?
Sales.
And we credit sales. So we create our account here called sales. We create our account called sales account, and we credit it to 360. We credit it with the 360,000. And we say accounts receivable. We say accounts receivable. We say accounts receivable. And then we have our purchases account. We have our purchases what?
Account.
Our purchases account. We are told our purchases amounted to 253,200. 253,200. When we buy on credit, we debit purchases and we credit accounts payable. We debit purchases and we credit accounts payable. And here we say accounts payable. Say accounts payable, account, and here we say purchases. We say what?
Purchases.
Purchases account with 253,200. 253,200. 253 what?
200.
200. 253,200. 253,200. 253,200. Then we are told. Number 4, discounts for the year ended 30th of September 2019 were as follows. Discount allowed, we know, is an expense that reduces accounts receivables. So we come here, we reduce accounts receivables, discounts allowed, we credit it with 960. 9 what? 960, and we debit discount allowed expenses account. Discount allowed account. Debit discount allowed expenses account with 960. With the 9 what?
60.
And we say it is from accounts receivable. It's from accounts receivable. Then you're told discount received is from creditors. You're receiving it from creditors. The creditors are reducing their claim against us with 900,000. So we debit to reduce accounts payable, we debit it with 900,000, and we say discount what? Discount received. Discount received. Discount received account, and therefore you create a discount received account. Let me erase part of this. Discount received account. Discount received. So we create a discount received. It's an income account. And as you do that, you are already remembering what to do in your income statement. that this is other income. This is other what?
Income.
These other incomes, and this is from accounts payable. It's from accounts what?
Payable.
Payable. It's from accounts payable. It's from accounts payable. Then you're told, bad debts written off. Bad debts written off for the year amounted to 240,000. Amounted to 240 what? Thousands. Amounted to 240,000. Amounted to 240,000. So if we were to write off, we reduce accounts receivable with the bad debts. With bad what?
Debts.
Bad debts. So we credit accounts receivable. We credit accounts receivable with 240. With 240 as we debit bad debt expenses account. As we debit bad debt expenses account. Bad debt expenses account, and you're saying it is 240 and it is coming from accounts receivable. It's coming from, we are writing off debt. We are writing off what?
Debt.
We are writing off debt. Writing off debt. Writing off debt. Additional information number 6, you're told. On 1st of April, Regina purchased 1st of April 2019. 1st of April 2019. Remember, 1st of April 2019 is mid-year. It's mid-year. Regina purchased some equipment for the use in business at a cost of 600,000. So we are not actually depreciating. So we are purchasing equipment. So we are saying we are purchasing equipment. So we are purchasing through bank. We are purchasing through bank 600,000. And we debit equipment account. We debit equipment what?
Accounts.
We debit equipment account. We debit equipment account. We debit equipment account. And you are told you're not depreciating it. It is 600. And it's coming through bank. It's coming from bank account. It's coming from bank account. Then we are told, additional information number 7. The following expenses were paid by check during the year. Salaries, that is 6 to 10. So we pay salaries. That is 6 to 10. So we debit salaries. I don't know whether you have salaries account anywhere. You don't have salaries. You don't have any salaries arrears. So we create a salaries account. You create a salaries what?
Accounts.
Salaries account, that is 6 to 10. That is 6 to 10. That is 6 to 10 from bank. From what?
Bank.
From bank. Then we are told rates, insurance, and electricity. Rates, insurance, and electricity. Rates, insurance, and electricity. Check whether we had balance brought down for rates, insurance, and electricity. We can see we have electricity here. So we call it rates, insurance, and what? Electricity. So we spend rates insurance of 23,280. 23,280. 23,280. 23,280. 23,280. We credit as we debit electricity here. 23,280. 23,280 through bank. Through what?
Bank.
Through bank account. Through bank account. Then we have interest on the loan. We have our interest here. The loan interest expense is 1350, but we are told out of this 1350, we have paid 900. You have paid how much?
900.
We have paid 900 through bank. We paid through what?
900.
Bank. We have paid 900 through bank. Therefore, 1350 minus 900. 1350 minus 900 is 450. 450. So 450 is loan interest payable. 450 is loan interest what?
Payable.
Payable. So we actually need to record that clearly. That is loan interest payable. 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 I don't like it here. Interest payable. Interest payable. I like putting all my workings on the workings. Everything on the workings. So when I prepare the financial statements, I will just not work on anything. And those are the Those are the adjustments which were supposed to be done before deduction. You need to reduce. You need to ask yourself, how much accounts payable did we pay? And how much did we receive from accounts receivable? So now, we are told about the accounts payable. At the beginning of the year, we had a liability of 2.7. We purchased on credit 253,200,000, and we were given a discount of 900, and the balance is 3,000. So the difference between the two is the amount we paid. 2,700 plus 253,200, 253,200. By the way, sorry, bank. We have said here we have paid loan interest. Loan interest. We have paid
900.
900. 900. Let's yes, 900. That's true. 900. Yes. Good. So here we add them up. We add the accounts payable up, and we get a figure of 2,700 plus 253,200. We get to 255,900. 255,900 minus the discount of 900 minus the balance carried down on 3,000. We get a figure of 252,000. 252 what?
1,000.
So we have paid 252. Our liability that we have paid is 252,000. It's a balancing figure. So we say it goes to where? It goes to bank. It goes to where?
Bank.
It goes to bank. 252,000 goes to bank. It goes to bank. It goes to what?
Bank.
It goes to bank. It goes to bank. And you're saying accounts payable. Accounts payable, 252,000. 252. Then we do the same to accounts receivable. To accounts receivable. To accounts receivable. We do the same to accounts receivable. And we say the total accounts receivable is 360,000. It is 360, 1, 2, 3, plus 5,400. We get 365, 400. 365, 400 minus 960 discount minus bad debt of 240 minus the balance of 7,200. We get a figure of 357. 357,000. That is the amount of money we collected. That is the amount of money we did what?
Collected.
We collected through bank from debtors. That's the amount of money we collected through bank from debtors. So we come here and we say accounts receivable. We say accounts receivable. But there is something we have missed here. Accounts receivable is a figure of 357. 357,000. 357,000. We said we got a loan here. We said we got a loan. A loan of how much? A loan. Why is our loan? Yeah, the loan that is acquiring us interest. Yes, 15% loan. We got a loan of 15% on additional information number what? 12,000. We got a loan of 12,000. We were paying. We paid the loan. We paid the loan here. We paid the loan here from 12,000 loan account. Where is our loan account? Where is our 50? Yeah, our loan account here we credited. Sorry, so this one we recorded badly. Balance brought down for the loan should be 12,000 on the credit side, and balance carried down is 6,000 on the debit side. So we are paying through bank. We are paying through what?
Bank.
We are paying through bank an amount of 6,000. So here we are paying a loan 6,000. Our bank is reducing 6,000 as we reduce the loan with what? with the 6,000. As we reduce the loan with 6,000. I reduce the loan with 6,000. So we do it that way. We do it that way. We do it that way. Let me see what we get when we add up the 6,000, the payment 6,123 plus that is 6 to what? Salaries. That is 6 to 10 plus that is 6 to 10. This is that is 6 to 10. Additional plus that is 6 to 10 plus that is 6 to 10, that is 6 to 10 plus 23 to 80, 23 to 80, 23 to 80 plus 900 plus 252,000, 252,123 plus 6,000 plus 15,630. 15,630. 15,630. That gives us 340, 020. 340, 020. 340 what? 0 what?
20.
340, 020. But you must remember what we are told additionally for version number 2. We are told Regina did not maintain the records of cash withdrawn from bank for personal use. The balancing figure in the bank account is to be treated as drawings. It's to be treated as what? As drawings. So we add the two and whatever balance, because we already have the balance carried down, it's 15,630. But the difference between the debits and credits will be drawings. The difference will be what? Drawings. So we add the two, we add the debits, 1620 plus 357,000, 357,123. We get a figure of 358, 620, 358, 620. 620 minus 340, 020 minus 340, 020. We get a figure of we get a figure of okay. Let's re-add the credit side. At least you know the debit is 358, 620. Let's add credit side. 600 plus that is 6 to 10. That is 6 to 10 plus 23 to 80. 23 to 80 plus 900 plus 252,000. 1, 2, 3 plus 6,000 plus you even add the balance carried down plus 15,630. We get a lot of 334,620. You get a lot of 334,620. You subtract 358 minus 358,620. We get a balancing figure of 24,000. 24,000, and we are told that that balancing figure is drawings. That balancing figure is what?
Drawings.
Drawings. So we create a drawings account. We create a drawing what? We create a drawings account which has a balance of 24,000. Draw bank. Draw what?
Bank.
Draw bank. And the rest is a matter of if there is no movement in the motor vehicles, if there is no movement in the vehicles, definitely we are talking about depreciation. We are talking about depreciation of motor vehicle of 1,500. We are talking about depreciation of furniture and fittings. What did we buy? There is something we bought. equipment. We added equipment. We added equipment. I hope we created an equipment account which should not have been created. Yes, this equipment account should not have been created. Our equipment account, we bought an equipment worth 600 here, and therefore you can see the total for equipment. But we are told that this equipment was not depreciated. This equipment was not depreciated, so the difference between the opening and closing is depreciation. The difference between the opening and closing is depreciation, 4,800 minus 3840, 3840. The difference of 960 is depreciation. The difference of 960 is depreciation. Land and building has not changed. Furniture and fittings, the difference is depreciation. 2400 minus 1920. 2400 minus 1920 is 480. 480. 480. Accounts receivable, loan, interest, we know it's 13 something. Rates, you can see the rates. You can see the rates. We had, we actually paid rates, we paid 23. We paid rates through bank, rates and interest 23,280. 23,280. 23,280. 23,280. This is the opening, this is the closing. 180 plus 23,280, get a figure of 23,460. 23,460. 23,460. Our balance brought down for rates, prepaid rates. Then here we are calling it electricity. Rates, insurance, and electricity. This account and this account are supposed to be combined. They're supposed to be combined. They're supposed to be combined. Prepaid rates. Yes, it's supposed to be combined. 23,280, yeah. And that's why that's 23,280 is coming here. 23,280. Electricity, so very interesting about this account. So rates, insurance, and electricity. So for the rates, we had a prepaid rate of 180 and 240. 180 and 240. But electricity was a liability. Electricity was a liability of 300 and 480. Electricity was carried down, is a liability of 300 and balance carried down. A liability of what? Of 480. A liability of 480. We add them up to get a total balance for all of them. But we must know that these are prepayment, and this is a liability. So we want to know what we incurred in the course of the period. 180 plus 23,280 plus 480 is 23,940. 23,940. 23,940. 23,940. And therefore, what we are taking to P&L as an expense minus 300 minus 240 we take a figure of 23,400. We take a figure of 23,400 in the income statement as an expense of rates, insurance, and electricity. So we can actually remove this. Can actually remove this. $23,400, and we come back with the loan we have of that. Our balance carried down is 6,000. Accounts receivable, we have sorted this 255,900, and everything is there. We are ready to prepare our income statement, knowing very well that we have been told at the beginning that she makes a gross profit to cost of sales of 3/7 per annum. Gross profit to cost of sales of 3/7 per what? Per annum. So you get a cost of sales, and then we use it to get our gross profit and also get everything that we need. So I want to capture these balances here so that I will not lose them, so that I can use that place for preparation of the income statement and balance sheet. So discount received is an income amounting to 900. Bad debt is an expense amounting to 240. Sales 360,000. Purchases 253,200. 253,200. Discount allowed is an expense of 960. Salaries that are 6 to 10. Interest payable 450. Interest payable how much?
450.
450. Yes, so now we can erase that place and you use it to prepare the bank statement. Use it to prepare the bank statement. So we erase this, we erase this, we erase this. Now if you look at that question, it is clear we have not been given the closing stock. We've been given the purchases, we've gotten sales, we've gotten everything, but we've not been given the closing what?
Stock.
We've not been given the closing stock. So I'll show you how to compute the closing stock based on the figures given. We are saying, if you look at the question, we now are able to say le general income statement for the year ended 30th of September 2018. We have our sales. We have our what? And we say everything is in shillings in thousands. And our sales figure is, our sales cannot be 360. Our sales is 360,000. Our sales is 360,000. Our sales is 360,000. We say less cost of goods sold. Less cost of goods what? So we don't have of these at the beginning company. Yeah, we actually have inventory. We have, and you see, like we say, we were given the opening inventory, we are not given the closing inventory. So we have opening inventory. We have opening inventory of 3,600. We add purchases. We add what?
Purchases.
Which we said it is 253,200. 253,200. 253,200. That is 600. Plus 253,200. You get a figure of 256,800. You get a figure of 256 what? 800. You get a figure of 256,800. You get a figure of 256,800. 256,800. We are say less what? Closing stock. Less closing stock. We say we don't know our closing what?
Stock.
Don't know our closing stock. But we've been told, the question clearly shows you closing stock is not given. But there is something, it is a clue you have been given at the beginning there. We are told that she makes a gross profit to cost. Gross profit to what? Gross profit to cost, cost of goods sold is equal to 3 out of 7. Gross profit to cost is 3 out of 7. And we know that if you want to move from, this is what you call markup. This is what we call markup. Markup on cost. What you mark up on cost. We want to move from markup to margin, to gross profit to sales. That is gross profit to sales. We only get the numerator, we add to the denominator. We get the numerator, we add to the what? Denominator. And the vice versa. 3 over 7. 3 over 7. So 7 plus 3. 3 over 7 plus 3. If you want to come from margin to gross profit, to markup, you subtract the numerator. You subtract the what?
Numerator.
The numerator. So our gross profit margin becomes 3 out of 10. 3 out of 10. It therefore means gross profit divided by sales is equal to 3 over what? It is equal to 3 over 10, and therefore, which is equal to sales is 360,000. So we ask ourselves, what is the what? What is the gross profit? So we call it, let's call it P. What is the gross profit? P. So from this, we are able to say P is equal to, we multiply by 360 both sides, 3 over 10 times 360. 3 over 10 times 360, which is 3 over 10 times 360, you get what? 3 divided by 10 of 360, 1, 2, 3, you get a figure of 108,000. So our gross profit is 100 and what? 8,000. If we know that our gross profit is 108,000, and our sales, our sales is 360. It therefore means sales minus cost of goods sold, we get 360. Sales minus cost of goods sold is equal to what? Is equal to 360. Is equal to the gross profit. Is equal to the gross profit, which therefore implies that our gross profit, cost of goods sold. Cost of goods sold is equal to 360,000. Sales minus cost of goods sold is equal to 180. Gross profit 108,000. 108 what? Thousands. And therefore
360.
Cost of goods sold is equal to 360,000 minus 108. which is equal to what? 360, 123 minus 108, 123, you get a figure of 252 thousands. 252 what?
Thousand.
Our cost of goods sold is 252 thousands. Our cost of goods sold is 252 what? Thousands. If our cost of goods sold is 252 thousands and cost of goods available for sale, minus closing stock, we are saying it is equal to 252 thousands. Is equal to 252 thousands. So what is X? What is X? So we are saying 256,800 minus X is equal to 252 thousands. We want to find out closing stock. What is closing stock? We say if we add minus X both sides, we say 256,800 minus 252,000, we get X. We get what?
X.
We get our closing stock. We get our closing stock. And that's where the biggest trap was. We get our closing stock, 256,800, 256,800 minus 252,000, 252,123. We get our closing stock of 4,800. Our closing stock is equal to 4,000 what?
800.
That was the biggest trap there. Our closing stock is 4,800. So we capture our 4,800 here. And we say cost of goods sold. We get our gross profit 108,000. We have actually said it. $108,000. From there, we say, let's what? No, we have income. We have an income called discount received. We have a discount received of 900. Add other incomes. Add other what?
Income.
Discount received of 900. Of 9 what?
100.
We get 108, 900. We get 108, 900. 108, 900. We say total. This is aggregate income less expenses. Less what?
Expense.
We quickly go through our expenses. Depreciation for equipment, we say it is 960. Equipment depreciation is 960. Depreciation, equipment, 960. Furniture and fitting, 480. Motor vehicle, 1,500. Bad debts, 240. Discount allowed, 960. Bad debts, 240. Discounts allowed, $960. Bad debts, 240. Loan interest expense, 1350. Remember, we record what is in card, not what was paid. Rates, insurance, and electricity. It is is 23,400. Salaries, that is 6 to 10. Yes, those seems to be my expenses. Those seems to be my expenses. And therefore we add them up. We add them up. We add them up. 960 plus 480 plus 1500 plus 960 plus 240 plus 1350 plus 23,400 plus that is 6 to 10. That is 6 to 10. We get 65,100. We get 65,100. 100. We say total expenses. Total what?
Expenses.
So we get profit for the year. Profit for the
Yeah.
Profit for the year. We subtract 108 minus 108,900. Get a figure of 43,800. 43 what?
800.
Our profit for the year is 43,800. 43 what?
800.
So we capture that figure here. We capture that figure here. Profit 43,800 to be captured in the balance sheet. To be captured in the what?
Balance sheet.
The balance sheet. 43,800. 43,800 to be captured in the balance sheet. So we quickly get the balance sheet, and I want to ask you again, please like, share, subscribe, inform your friends, let them join us, even as we help you to succeed in your accounting profession. Join us in our online classes. This we have done for 16 solid years, and I can assure you that we are among the best in our region. We are among the best in our region. So quickly, we now do the balance sheet using the assets we already have. We already know our assets, our equipment, land and building, equipment, furniture, and fittings. So the lady is called Regina Rai. The lady is called Regina Rai. Regina Rai. Regina Rai. Statement of financial position. Statement of what?
Financial position.
Financial position. Asset. That as at 30th September 2019. Is that is September 2019? And we can actually do correction here, and we say assets, non-current assets, and we say we want to get cost, provision for depreciation, and net what? Net book?
Right.
Net book value. Land and building is not changing. It's moving from 18 to 18. So land and building. $18,000, no depreciation, 18,000. Everything is shillings in thousands. Shillings in thousands. Shillings in what? In thousands. Then we come to equipment. Equipment, we are saying it is 5,400. Equipment, it is 5,400. And we say that the depreciation is 960. Furniture and fitting is 2,400. Furniture and fittings, we said it's 2,400. This one, and the depreciation is 480. The depreciation is 480. Motor vehicle, we said it is 6,000, and the depreciation is 1,500. 6,000 and the depreciation is 1,500. So those are the non-current assets. So we get their balances very, very fast. 5,400 minus 960, 5,400 minus 960, we get 4,440. 2,400 minus 480, 2,400 minus 480, get a figure of 1920. 6,000, 1, 2, 3, minus 1,500, we get 4,500. We add them up, plus 1920, plus 4,440, plus 18, 1, 2, 3, we get a figure of 28,860. Get a figure of 28,860. That is total non-current assets. Then we come to current what?
Assets.
Current assets. And you always start with inventory and accounts what? Accounts receivable. Inventory and accounts receivable, and we said that our closing inventory, we calculated our closing inventory in the income statement. We did a calculation and we said it was 4,800. Our closing inventory was 4,800. Our accounts receivable from the workings, our accounts receivable from the workings, it is here for 7,200. 7,200. It is here. 7,200 what? 200. Then we come to prepaid rates. Prepaid rates, we said it is 240. Prepaid rate is 240. Prepaid rate is 240. And then we have our bank balance. We said it is 15,630. Bank balance, we say it is 15,630. 15,630. I think those are the number we need to add up. We need to add them up. 4,800 plus 7,200 plus 240 plus 15,630. We get 27,870. 27,870. Total current assets. Total current assets. And then we say total assets. Total what?
Assets.
Total assets. Total current assets plus total non-current assets. 28,860. We get a figure of 56,730. 56,730 as our total asset. 56,730 as our total asset. Where did we get the money from? We say financed by. Financed by, and we say capital and what? Capital and liabilities. Capital and liabilities. We are financed by capital and liabilities, and we did calculate our capital. We did our working of our capital. We did our working of capital, and we said that our capital is 27,000. Our capital from our workings, we said it is what? That's the first thing we calculated. That's the first thing we calculated. And then we say add profit for the year. Add profit for the year. And you see the profit is 43,800. 43,800. plus 27,000 plus 43,800. What is this? This we said this is a profit. We said this is a profit. We say this is a profit. 43,800. So we bring it there. 27,123 plus 43,800. We get 70,800. Then we say less what? Less drawings. Less drawings. How much were the drawings? How much were the drawings? Where is our drawings account? We said our drawings were 24,000. Our drawings were 24 what?
1,000.
We subtract 24,000. 70,800 minus 24,123. We get 46,800. We get 46,800. And that is closing capital. That is closing capital. Do we have a loan? We have a loan somewhere. Yes, 12,000. We have a loan somewhere amounting to 12,000. So non-current liabilities. Non-current what?
Liabilities.
Non-current liabilities of a loan of 6,000. The balance was 15% loan. 6,000. Then we go to current liabilities. We go to current what?
Liabilities.
And we know always the format. Remember the format in the head. Current liabilities start with bank overdraft, then trade payables. And we said our trade payables is 3,000. Accounts payable. Our accounts payable is 3,000. We also said that we have interest payable of 450. We also had electricity. Is it electricity or rates payable? 480. Electricity payable of 480 from whatever. Yes, accrued electricity 480. Electricity payable 480. Electricity payable of what?
480.
480. Electricity payable is the last item there in the list of assets and liabilities. Electricity payable 480. So if we add the three, we get 480 plus the 3,000, 123 plus 450 plus 480. We get a figure of 3930. We get a figure of 3930. 3930. So we now add the current liabilities to non-current liabilities and closing capital to find whether they will agree with the total assets. So 3930 plus 6,123 plus 46,800. 46,800, and it gets to 56,730. 56,7 what? 30. 56,730 is the same as this. So our assets is equal to capital and what? Liabilities. 56,730 is capital plus capital and liabilities. Total capital and liabilities. 56,730. 56,730. That's the way the question was supposed to be done. Once again, I want to urge you, like, share, subscribe, and join us as we help you to pass in your exams and become a professional accountant. I want to repeat again, join our online classes. We are simply the best. For the last 16 years, this is what we have been doing. And I want to assure you that we are the best in this area. Thank you very much.